The history of Wall Street is not merely a record of boom and bust cycles, but a graveyard filled with investors who ignored the fundamental immutable laws of finance. The great collapses, the panic of 1907, the devastation of 1929, the dot-com bubble burst in 2000, and the great financial crisis of 2008 all share a common tragic thread, an overwhelming belief that this time is different, leading to the abandonment of proven historical warnings. Wealth is not built on novelty or fleeting trends, but on the systematic application of timeless principles forged in the heat of financial catastrophe. These 10 rules, refined over centuries by the greatest minds in finance, serve as your essential map to navigating future volatility and securing genuine long-term wealth, ensuring you survive the next inevitable storm while others are swept away by panic. Before we delve into the core principles that separate financial survivors from historical footnotes, we must address the engine that drives this educational effort. The content we provide is designed to equip you with the mental tools necessary to thrive when market conditions become challenging and confidence begins to waver, acting as a reliable compass when the financial seas grow rough. To ensure this kind of deep, historically grounded analysis continues to reach those who need it most, please take a moment right now to subscribe to the channel and leave a quick comment below, even if it is just a single word or emoji. This simple action significantly boosts the algorithm's ability to recommend this crucial content to a wider audience, confirming to me that these complex, high-value discussions are truly worthwhile and necessary for the community. The first and arguably most difficult rule to internalize is the necessity of separating your personal emotions from your capital decisions. Never meet a margin call with your emotions, because fear and greed are the greatest and most reliably recurring expenses an investor will ever pay. This psychological vulnerability was brutally exposed during the panic of 1907, where bank runs and cascading failures were magnified by the instantaneous, irrational decisions of highly leveraged individuals desperate to liquidate assets at any price. The Great Crash of 1929 further cemented this lesson, demonstrating how the widespread use of margin, borrowed money, turned minor corrections into wholesale psychological collapses as fear forced millions to sell into a freefall, magnifying their losses exponentially. The legendary trader Jesse Livermore, who operated successfully through several major market upheavals, recognized that the true key to survival was not predicting the market's direction, but controlling his own temperament. He understood that the market's irrationality could be capitalized upon, but only if he maintained a cold, objective discipline while others succumbed to the emotional herd. Livermore meticulously documented how his biggest losses often stemmed not from being fundamentally wrong about a stock, but from allowing hope to delay a necessary sale or letting fear rush him into a premature, damaging exit. This rule teaches us that mastery over the market begins with the exhaustive mastery over the self, treating trading like a calculated business rather than an emotional outlet. The second fundamental rule, established in the aftermath of the 1930s depression, states that the market functions as a voting machine in the short run, but it always operates as a weighing machine in the long run. Price reflects the temporary popularity, hype, and collective sentiment of the moment, driven by fleeting news cycles and social exuberance, making short-term movements largely unpredictable and often absurd. Value, conversely, is the intrinsic worth of the underlying business, determined by its assets, earnings potential, and cash flow generation capabilities, which reliably dictates its true gravitational pull over extended periods. This critical distinction became the foundation of value investing philosophy, formally codified by Benjamin Graham and David Dodd. Graham's seminal work, The Intelligent Investor, 1949, introduced the enduring Mr. Market analogy, providing a perfect metaphor for this rule. Mr. Market is your manic-depressive business partner who shows up daily, offering to buy your stake in the business or sell you his at wildly fluctuating, often completely nonsensical prices, driven purely by his current mood. The intelligent investor is advised to ignore Mr. Market's daily emotional outbursts and instead focus exclusively on the verifiable intrinsic value of the business held, exploiting Mr. Market only when his emotional state allows the purchase of high-quality assets at a significant discount. This philosophy demands patience and intellectual honesty, requiring the investor to anchor decisions in fundamental reality rather than speculative fantasy. The third rule is a warning against impulsive action in volatile conditions. Never try to catch a falling knife, but instead wait for the market to definitively prove your thesis right before making a major commitment. A falling knife refers to a rapidly declining asset whose price is plummeting due to unexpected bad news or a sudden shift in sentiment, and attempting to buy the absolute bottom often results in sustaining deep cuts. Early 20th century speculators learned this lesson repeatedly, finding that attempting to anticipate the exact moment of reversal was a fool's errand that consistently led to premature entry and capital destruction. Prudent investment requires evidence of stabilization, not merely an optimistic hunch about where the floor might be located. Jesse Livermore, whose methods required precise timing, developed a sophisticated practice known as trend following, built on the principle of waiting for the line of least resistance. He would observe a stock and wait until it clearly demonstrated a confirmed breakout or a solid reversal pattern, minimizing exposure to rapid, unconfirmed price movements that could swiftly wipe out his capital. This approach acknowledges that while waiting for confirmation might mean missing the absolute first few percentage points of a move, it vastly reduces the probability of being trapped in a dead cat bounce or a continued structural decline. Successful investing is about maximizing certainty and minimizing risk exposure, prioritizing capital protection over the fleeting thrill of perfect prediction. The fourth essential rule in finance is that sufficient diversification stands alone as the only free lunch available to investors seeking to manage risk without sacrificing expected return. Concentration, while offering the potential for spectacular, rapid wealth gain, simultaneously carries the risk of total, catastrophic loss if a single, unforeseen event destroys that concentrated fortune. The South Sea bubble of 1720 provided a stark, early historical demonstration of this truth, where investors who poured their entire wealth into a single, wildly speculative scheme watched their fortunes vanish overnight when the bubble inevitably burst. Similarly, the frequent collapses of concentrated railroad bond holdings in the 19th century taught painful lessons about the systemic risk within single sectors. The mathematical foundation for this rule was provided by Harry Markowitz in 1952, whose pioneering work on modern portfolio theory proved that combining uncorrelated assets significantly reduces non-systematic risk specific to a single company or sector, by spreading capital across diverse asset classes like stocks, bonds, real estate, and international holdings. An investor ensures that a poor performance in one area is usually offset by stability or growth in another. This strategic spread smooths out returns over time, protecting the overall portfolio from the isolated shocks that can easily decimate an undiversified holding. Diversification is, therefore, a strategic hedge against the unknowable future, a necessary shield against the inherent uncertainty of individual investments. The fifth rule dictates the timeline and mechanism for wealth creation. Maximize the power of compounding by starting early and staying consistently invested, making time your most valuable asset. Compounding is the process where earnings generate further earnings, which in turn generate even more earnings, leading to exponential growth that accelerates dramatically the longer it is allowed to run uninterrupted. The historical success of long-term savings institutions and the slow, inexorable rise of global economies over centuries are testaments to the quiet, irresistible force of this principle. Delaying investment, even by a few years, fundamentally compromises the potential final outcome, because the early years are when the capital base is established, allowing the exponential engine to begin its work. This mathematical concept is often credited to Albert Einstein, who allegedly called compounding the eighth wonder of the world, a testament to its profound and often counterintuitive power. Consider two investors, one who invests a large sum later in life, and another who invests a small, consistent amount starting early. The early investor, despite contributing less principal, almost always generates superior final capital because their small investments benefit from decades more time in the market, allowing the exponential curve to steeply ascend. The lesson here is simple yet profound. Consistency and time are non-negotiable partners in wealth accumulation, and the most powerful financial decision you can make today is simply to begin the compounding process immediately. The sixth rule is a cold, hard mathematical truth. Minimize investment expenses, because high costs are the only certainty in a world of financial uncertainty. Every fee, every commission, and every expense ratio charged against your portfolio is a guaranteed reduction in your long-term returns, regardless of how well the underlying investments perform. During the 1960s and 1970s, the investment landscape was dominated by high-fee, actively managed funds that promised market-beating returns, but often delivered mediocrity after their substantial costs were deducted. These costs acted as a persistent, invisible drag on performance, silently destroying billions in potential investor wealth over time. John Bogle, recognizing this fundamental mathematical flaw, founded the Vanguard Group in 1975 and subsequently introduced the first retail index funds. Bogle's insight was revolutionary. Since active management often failed to beat the market before fees, offering a low-cost fund that simply tracked the entire market index would mathematically guarantee superior long-term results relative to the high-cost alternatives. He proved that even seemingly small annual fees, like 1 or 2%, compound devastatingly over decades, ultimately stealing a massive percentage of the final portfolio value. Controlling these certainties, the costs, provides a guaranteed advantage over those who chase expensive, speculative promises. The seventh rule implores investors to always know the difference between intrinsic value and speculative frenzy, demanding the avoidance of the destructive herd mentality that fuels financial bubbles. A speculative mania occurs when asset prices decouple entirely from their fundamental utility or earning potential, driven purely by the psychological belief that someone else will pay an even higher price tomorrow. This collective delusion is a recurring feature of financial history, demonstrating that human nature, not economic structure, is the primary driver of extreme market cycles. Avoiding the herd means resisting the powerful social pressure to participate in what appears to be effortless, rapid wealth creation. The quintessential historical example remains the Dutch tulip mania of 1637, where the price of specific tulip bulbs, particularly the Semper Augustus, skyrocketed to levels equivalent to houses or entire estates. At the peak, a single bulb was merely a flower, yet its price was dictated entirely by speculative belief, illustrating the complete detachment from utility or intrinsic value. When confidence finally wavered, the market collapsed instantly, leaving speculators holding worthless contracts and demonstrating that even the most seemingly rational individuals can be swept up by the intoxicating promise of effortless riches. Recognizing the mania requires intellectual distance and the courage to stand apart when everyone else is rushing toward a guaranteed historical disaster. The eighth rule is a directive to embrace contrarian thinking, encapsulated by the simple yet difficult instruction: buy straw hats in winter, meaning be willing to purchase assets when they are out of favor, cheap, and universally despised. Financial markets operate in cycles, swinging wildly between extremes of irrational exuberance, euphoria, and deep, equally irrational pessimism, despair, creating predictable opportunities for those willing to act against the prevailing sentiment. True value is often found at these cyclical lows, when assets are depressed not because their fundamental quality has vanished, but because market sentiment has completely collapsed. This requires immense emotional fortitude, as buying low means investing when the economic news is bleakest and fear is highest. Bernard Baruch, a highly successful financier who navigated the booms and busts of the early 20th century, famously captured the essence of market euphoria when he stated he knew it was time to sell when the shoeshine boy is giving stock tips. This anecdote highlights the danger of universal participation and optimism, which signals that all available capital has already entered the market and there are no buyers left to push prices higher. The successful investor must cultivate the necessary detachment to recognize these sentiment extremes, acting decisively to acquire valuable assets during periods of maximum pessimism, understanding that the greatest returns are earned when others are too fearful to invest. The ninth rule, famously articulated by Warren Buffett, is the bedrock of long-term financial survival. Rule number 1 is never lose money, and rule number 2 is never forget rule number 1. This principle emphasizes that risk management is not a secondary consideration but the defining factor of longevity in finance, acknowledging that preventing catastrophic drawdown is statistically more important than seeking maximum profit. A 50% loss requires a 100% gain just to break even, illustrating how quickly major losses can permanently cripple the exponential growth engine of compounding. Sustainable success is built on consistent, moderate returns and rigorous downside protection. Throughout the 20th century, catastrophic trading losses demonstrated repeatedly that uncontrolled leverage and poor risk sizing are the primary killers of capital. In response, rigorous quantitative methods were developed, such as the Kelly criterion in the 1950s, which mathematically determines the optimal bet size to maximize long-term wealth while preventing ruin. The Kelly criterion's application underlines the necessity of placing bets proportional to one's confidence and capital base, ensuring that no single loss, no matter how unexpected, can fatally wound the portfolio. Prioritizing capital preservation means focusing on surviving the bad times so you are fully capitalized and ready to seize the opportunities that inevitably arise during market recoveries. The final 10th rule often proves the hardest for active individuals to embrace. Financial success frequently favors the inactive investor who avoids excessive trading and embraces a long-term buy-and-hold mentality. The urge to constantly do something, to trade, to adjust, to time the market, is a powerful psychological drive, but it is statistically detrimental to wealth accumulation. Frequent trading introduces 3 massive erosive forces: transaction costs, capital gains taxes triggered by short-term sales, and, most importantly, the high probability of making psychological errors at precisely the wrong moment. The market does not reward activity. It rewards patience and the ability to sit still. A vast body of financial analysis comparing high-turnover brokerage accounts with simple buy-and-hold strategies consistently shows that the inactive investors achieve significantly superior net returns over extended periods. Warren Buffett's famous statement that his favorite holding period is forever is not hyperbole, but a profound understanding of this rule. By minimizing trading, the investor allows compounding to work its magic uninterrupted, avoids unnecessary tax liabilities, and dramatically reduces the chance of impulsive, fear-driven sales. True discipline often means doing nothing at all, allowing high-quality assets purchased at fair prices the necessary time to generate exponential returns. These 10 rules, spanning centuries of market history, provide a comprehensive, timeless framework for financial success, integrating psychology, valuation, and rigorous risk management into a cohesive strategy. We began by establishing that mastering personal temperament, Rule 1, is paramount, ensuring that fear and greed do not sabotage rational decision-making. We then moved to valuation, emphasizing the necessity of focusing on intrinsic value over fleeting price, Rule 2, and the importance of waiting for market confirmation before acting, Rule 3. The remaining rules focused on defense and optimization, stressing the protective power of diversification, Rule 4, the exponential engine of compounding, Rule 5, and the guaranteed advantage of minimizing expenses, Rule 6. Finally, we explored the crucial lessons of market cycles, recognizing speculative mania, Rule 7, embracing the contrarian opportunity of buying low, Rule 8, prioritizing the absolute preservation of capital, Rule 9, and understanding the powerful virtue of long-term inaction, Rule 10. These are not merely historical anecdotes. They are codified survival strategies that guarantee a stronger financial future if applied consistently, transforming history's costly mistakes into your personal blueprint for enduring prosperity. By internalizing and implementing these immutable laws, you equip yourself not just to survive the next financial crisis, but to capitalize on the opportunities it inevitably creates. To further deepen your understanding of these psychological and strategic principles, particularly those related to market temperament and trend following, there is one book that stands above all others as the definitive guide. Much of the wisdom we discussed regarding emotional control and precise entry points stems directly from the experiences of Jesse Livermore. We highly recommend the new edition of Edwin Lefebvre's classic, Reminiscences of a Stock Operator, which is the foundational text for serious traders and investors alike. This updated release provides a profound analysis of Livermore's psychology and market strategies, but it is enhanced with unique modern commentary and chapter breakdowns that translate his early 20th century market experiences into practical, actionable lessons for today's complex trading environment. This book is essential for anyone serious about elevating their financial discipline, transforming historical experience into immediate market advantage, and truly mastering the psychology required for long-term success. You can find the link to acquire this invaluable resource, ensuring you have the wisdom of the past guiding your future decisions, in the description below.